Final part of this chapter is the financial futures. So we'll see several futures. It's pretty narrative in our chapter. So first, stock index futures. You can actually have a futures contract with the stock indexes itself, such as S&P 500, Dow Jones Industrial Futures, Nasdaq Futures, Russell 2000 Futures, domestically, right? Especially after closing bell, the closing hour, you can always trade futures. So you can see the Dow futures changes. There may be a effect to the next day open price actually. So if something happened after closing bell, you can still see the market reaction based on the futures price. Nikkei 225 and FTSE 100 is Japan and the UK market index futures. You can also trade internationally. So what is the advantages over direct stock purchase? First, the transaction cost is substantially lower for the futures account, the futures market, and it's very easy to implement timing strategies, allocation strategies, because there's a structural the product that you can choose. Okay. Second one will be synthetic stock purchase. So instead of just really purchasing stock, you can actually just using futures index instead of actual shares, called a synthetic stock purchase. So it allows frequent trading at low cost because if you sell and buy stock frequently, then transaction costs are really high. Futures market is a lot lower. It's very useful for foreign investment because it's not every stock is accessible. You want to bet on the Japanese market, then you just trade Japanese Nikkei 225 stock futures. So comparing with the classic market timing strategy that we learned actually in the previous chapter, portfolio theory, which is the switch between T-bill and stock based on the market condition, right? You can actually have the same strategies using futures but cheaper, just buy and sell stock futures, stock index futures. So that's called the synthetic stock purchase. Index arbitrage. It's possible that underlying stock and futures contract are mispriced. So if you believe the future price is too high, then you can sell these futures because the futures are overvalued and buy underlying stock. If you believe the future price is too low, underpriced, then you can buy these futures and sell the spot one, the underlying stock. So it's called index arbitrage. However, it's very, very hard to do because transaction costs usually very big, a lot larger than your profit actually, because the arbitrage amount is really, really small usually. And the trade must be done simultaneously, which is almost impossible. So it's very difficult to do in practice. Currency futures. There is a forward market and futures market in currency, foreign exchange market. Forward market is more common in foreign currency. It's a largest market in the world, and it's usually available from large banks. And it's used very commonly, extensively to hedge foreign currency transactions. I believe the international finance actually class will teach this more detail. There's also a futures contract with major currencies. So futures contract should be traded in the exchanges, right? So it's only for major currencies like the CME, LIFFE, like London, Singapore, Chicago, March, June, September, December delivery contract usually available. And usually only for major currencies. Interest rate futures. Interest rate futures are also pretty common. So it's a major contract includes the contract on Eurodollars, T-bill, T-note, T-bonds. And you basically bet on interest rate. Some foreign interest rate contract also available. So short position in contract will benefit if the interest rate rise. if interest rate drops, then long position will be benefit. Hedging with futures often require cross hedge. It means that you cannot directly hedge usually using the interest rate futures. Many cases you have to use the futures contract with a different underlying asset, such as you can hedge corporate bond by selling T-bond futures because you cannot find exact futures contract. So interest rate may change pretty similarly, right? So corporate bond, you can hedge by selling treasury bond futures, which is common. You can get it. You can get covered, not fully covered, but covered in some degree, at some degree. So that's interest rate futures. So there's various ways to use the futures account. I skipped the swap part. Swap part is not that long. Swap basically is a bilateral agreement between two parties who wanna exchange things like such as the foreign currencies or interest rates. You can actually you can learn more detail in international finance class, or you learned, Okay, so this is the end of the chapter 17, which is the last chapter of this class. So last comment on this class is, well, investment theory class is introduction to investment class, so which means that it's not very advanced materials, but obviously you need to have much more advanced than the intro finance. And in addition, you need to have some technical skills such as mathematics and Excel or other programs. So my recommendation is, like, if you are interested in working this field, this is very good basic, but working more on technical stuff such as the mechanical stuff, computation stuff, mathematics, computer skills are pretty important. Obviously, having pursuing the financial designation exam is also very helpful. Okay, so I hope you enjoyed the class this semester, and thank you for watching the video lectures, and goodbye, and have a nice rest of semester.